All right. Hi, everyone. I'm Jen Calabrese from Calabrese Consulting, and welcome to our panel today. As we said before, we have Joe Fidi from Witham. We have Jocelyn from Arrell from Goodwin. We have Caitlin Van Valen from Odyssey and Paul Wood from BTIG. Just a quick introduction, I guess, if everybody wants to make a little bit of an introduction to themselves, and then we'll get started. Joe, if you want to start.
So, good morning, everybody. Joe Fidi. I'm a partner out of our New York, New Jersey office for Witham. Been working in the SPAC practice for a little over 10 years now.
Good morning. I'm Jocelyn Arrell. I'm a partner in the tech and life sciences practice at Goodwin. I've been working in the SPAC space since 2004. Thought it was a great opportunity for our emerging growth companies to go public after the dot-com boom, and have been through, seen several cycles, but I'm still a real believer in the opportunities and excited to see where we're going now.
Good afternoon. I'm Caitlin Van Valen. I run sales for Odyssey Trust Company. We are a transfer agent and trustee for many of the SPACs here, so it's nice to meet you.
Hi, everybody. My name is Paul Wood. I am one of the co-heads of the SPAC practice at BTIG. We focus on both SPAC IPOs and de-SPACs. We cover the entire life cycle of the SPAC product.
Great. All right, and Jen Calabrese from Calabrese Consulting, founder and CEO. We've been in the SPAC space since about 2013, have gone through all the ups and downs with everybody else, and currently working with approximately about 100 to 115 SPACs. And so we're happy to be here. And again, like we said, our topic today is the renewed focus on quality deals and due diligence. And I guess to kind of start it off, Paul, actually, I guess to really kind of start with you in terms of what you've been seeing on the target side. I don't know, if you have any thoughts on the type of targets that we're seeing these days, whether you're seeing more on the revenue side or profitability side, or even in terms of industries, what kind of industries you've been seeing in terms of the de-SPACs.
Sure, thanks. Yeah, there are certainly thematics that run through the SPAC industry and the types of targets that sponsors are looking for and that investors are looking for. And a lot of it starts with whether or not there are public comps and really what's being broadly invested in regular equity capital markets. So, right now we're seeing a few themes within sectors.
Right.
AI is particularly topical, but within there you have, autonomous vehicles. You also have SMRs, or small modular reactors, as a space.
Right. Yeah.
Also powering the AI boom. You have crypto for sure, which could be a panel on its own.
Yeah, that's a whole different panel.
Yeah. And so if you look at the companies that have de-SPACed recently, they all touch those verticals. And that's for any type of sponsor, particularly the most seasoned sponsors.
Right. It seems like we're seeing more on the revenue side, profitability side, or is it really,
I think that was the original topic of this panel, was, large revenue, very profitable, and the return of that trend to the SPAC market. And I think that's what everybody expected. Unfortunately, not unfortunately, but just to everybody's surprise, investors, and I think Doug hit on this very well, it is an innovative product, right? And when you see the convergence of, crypto and the SPAC product, there are avenues that have been opened recently, particularly from the easing or the rewriting of regulatory rules that are permitting this. And investors want this risk. We get asked often, how is this going to play out, and what is the receptivity to some of these perceived riskier transactions being announced? And these are transactions that investors want to see. And so I think that's why we're seeing a lot in the crypto space. Right. But then also in, growing sectors and, autonomous vehicles, for example. We've seen Kodiak was announced, plus AI was announced, and that's areas in Churchill, two very experienced, well-established sponsors that were going into these sectors and identifying great companies that don't necessarily have, hundreds of millions of dollars of revenue today, but they clearly seen quality management teams and proven technologies that have grown in the private space. that are now at a inflection point to go public.
Right. Yeah. And Jocelyn, I think that's kind of like something that you, I think, have seen as well in terms of the quality of the SPAC sponsors and their, the repeat sponsors coming into the space again.
Yeah, and I would agree with that, Jen. I mean, what we're really seeing is a focus on companies that are more mature, and I would say more ready to go public. So part of the diligence that the SPAC sponsors are doing, and frankly that the companies are thinking about, is ultimately at the end of this process, we're going to become a public company. And is the company ready? Is the management team ready? Do they have an avenue to have PCOB financial statements? Do they understand their business model? Are they going to be in a position to raise the capital that they need in order to be successful? For example, in the life sciences space, can they raise the capital to get to that next value inflection point where it's natural to then go back out into the marketplace and raise additional capital, and they'll have an easier time? Or are they, or is this a company that's just not quite there yet, right? Is it a company that, maybe needs a little bit more private capital and a little bit more growth in its business to be able to achieve sort of that next level? And I think, some of the companies that were visited last time may have signed, a de-SPAC transaction, but couldn't get it over the goal line, are now back and are ready to be public companies. There are also companies, with the last 2 years of a pretty slow capital market, that have been preparing to go public whichever way. SPACs give the company that control. They don't have to stand in a queue to go public and wait their turn. They can choose that it's the right opportunity for them, and they can work through and find the right SPAC sponsor and that right combination to take them public. And I also think companies are frankly listening. SPAC sponsors are telling them, really interested in the company, really interested in the technology, and it may be for our SPAC 12.
Right.
And we'll revisit potentially at a
So they're a lot more engaged in the process, I think, right?
A lot more engaged in the process, and I think deeper due diligence,
Right.
Up front, because I think that diligence up front, as opposed to rushing to announce the BCA,
Right.
doing the diligence up front, making sure it's financeable, those steps up front save time in the long run, save money, save frustration, and enable the clients to continue to build their companies.
So do you think they're doing more due diligence now than compared to maybe a couple of years ago? Like there's more renewed focus on that?
I think there's more. I definitely think that there's more focus, and we're also seeing the focus on financing the deals. Back in 2020, 2019, 2020, we were really focused on announcing deals with the financing package in place. Things have changed dramatically since then, but I'm working both on the sponsor side and on the company side with clients that are actively working to make sure that they announce the BCAs with the financing, and enough financing to get not just to scrape by and hopefully get to nirvana, that's the public market, but to really finance the company and allow the company management to focus on growing the company, hitting those projections, hitting those various milestones.
Post business combination as opposed to just enough to pay the transaction expense.
Exactly. And starting off life as a public company, with not a ton of stress on your back of having to go out tomorrow to raise, additional capital. And I've had SPAC sponsors that have said, love this company, but the market's telling us it's not financeable right now. Right. So we're gonna pass, and we're gonna find the next one, as opposed to, I called it the hope and prayer transactions that we were announcing, and then hoping by the time we closed that we would be able to magically have the amount of capital that the company needed.
Right. Yeah.
Well, on that note too, Jocelyn, wouldn't you say that there's a lot more mature private companies now? Because they've had to kind of hold off in the wings of this very tumultuous IPO market over the last couple of years. And so you have kind of a better growing bed, so to speak, for privately held companies that are better positioned to hit the public market than, let's say, back in 2021.
Right.
Yeah, I would say so, and I think it goes back to the last panel's a little bit of hesitancy in terms of how many SPACs are out there. We did hit a point where there were too many SPACs for the companies that were ready. We may not want to admit it, but that's sort of what happened. And so, people really need to think about the market saturation and the ability to take the right companies public. After all, it's everybody's reputation, and people that I'm working with in the industry really want to take great companies that really perform. And I think as an industry, it would be great if 2025, 2026, we really show the world that SPACs and IPOs are on par. There are going to be some traditional IPOs that don't perform as well. There are going to be some direct listings. But what we're talking about is optionality and really giving companies a choice at the end of the day as to how and when they want to pursue the public markets.
Right.
Yeah. And I think on that note, too, a lot of the target companies, like you said, really are looking to go public, and they want to go through either, mostly through either a SPAC vehicle or a traditional IPO. But a lot of them really don't understand what it means to be a public company and how that process really works. And I think, there's a lot of education that needs to go into that. And to really keep them informed. And I know, it's very difficult, like, as advisors, for us to come in and to be almost like that voice of reason, and to really be able to sit there and tell them, okay, yes, you want to be a public company, but you really need to do a lot of work. And going public is almost like the dress rehearsal. Being a public company is a lot more work post-business combination. And Joe, from your perspective, when you're looking at the targets, what is it that you see in them that you think, okay, this is really something that you should focus on?
Yeah, I think a lot of what we're talking about here, the theme is sophistication. Right. So as an auditor and the other auditors in the room, if you saw a target company with a 20-person accounting team, you're going to feel a little bit more excited that this company has a ways to go post de-SPAC, right?
Yep.
You have to know what you're in for. You have to understand your deal, what's waiting for you once everything closes, once all the dust settles, and now you're a public company, right? Is everybody on your team fully committed, not just to do the deal and have this access to capital post de-SPAC, but now you have to become a sophisticated public company. And you have a few years under emerging growth where you don't have as much to deal with, but it's still a public company style audit. What we would like to see is either, obviously, if you've already had the public company audit done, that's great. If not, something like an AICPA type audit that you have to uplift to PCOB. Knowing that you've been through this process in the past, it's similar. It's a little bit more intrusive. It's a little bit more work, but it is similar, and you've been down some sort of path before.
You have some type of experience, so it's not so much of a culture shock. If you've never had one before.
And a lot of these deals, you're dealing with pipes, you're dealing with equity forwards, non-redemption agreements. Some of that accounting has been taken care of in the SPAC process. Some of that might change upon a de-SPAC, or maybe not come into effect until a de-SPAC. So you have to be on top of all that stuff when your auditor comes in post de-SPAC. Do you have money for 2 years down the road to avoid some kind of going concern, or is your deal structured where you have these contingent liabilities that pop up and you're just simply not ready for them? That could be, how are you going to grow, especially if you're in some of these cases where you're a pre-revenue type company, you're looking to put in R&D, and you have these other contingent liabilities to deal with that just pop up. If you're missing these landmines and you're not relying on real advisors to help you get around them, then you're going to be in a lot of trouble.
Yeah, and I think that's very true. Making sure that everybody's prepared for that post-transaction phase. The whole thing with the redemptions and the de-SPAC process itself, it really does put a lot of pressure on the companies. And I think from an operational point of view, it's something that really needs to be addressed. And I think, Caitlin, you really do. This is where somebody like you really comes into play and lends a lot of guidance for that, right?
Yeah, absolutely. So most people have no idea what a transfer agent is until they have to. And so a lot of our role comes in quite early, in this process, because our job is to de-risk the transaction from an operational point of view. So one of the things that's really, as we try to push this industry forward, and we're talking about the innovation that's coming in, from a transfer agent and trust perspective, there's a few things that we're starting to do that are really helping to mitigate some of the material loss and risk around, one, the redemption process, but also around the de-SPAC process. And one of those things is an online medallion guarantee. I mean, who here has had a hard time getting a medallion to clear shares to transfer to your brokerage? Exactly. This has become a huge pain point, especially for foreign shareholders. So a transfer agent that offers the online medallion guarantee, we offer it up to an X medallion. That allows you to clear those shares directly online so that there is no material lag or loss for the shareholders. Things like instant batching. This has been huge for auditors.
Yeah.
The ability to send your auditor an activity report that same day, that is instant. There's a lot of transfer agents that are still batching overnight, so you can't do that till the next day. Emailing DRS statements. All of these things seem like little things, but when you are a sponsor, these become the big things. And so to have someone that is helping to push the industry forward has been really helpful for, the SPACs that we represent, but for the transfer agent and trust as a whole.
Right.
Yeah.
Yeah, that's true. I think that's very, very true. I think, a lot of people here have gone through the SPAC cycle from the previous years, and now we're in this, what we call the new generation, the next generation of the SPACs. Is there any lessons that we have learned, or that, either you, Jocelyn or Paul, that you've learned that people can really take going forward in terms of investments or types of things that they should really be considering?
Well, just one of the themes that I keep hearing on these panels, it's really, are there too many SPACs? Right. And we talk about quality deals, and on the other side of that coin is poor quality deals. And this concept of in 2021 there was 575 SPACs seeking targets. You're going to get poor quality deals, right?
Right.
We're at right now 81 SPACs that have a duration that'll take them into 2026 and over $100 million in trust.
Okay.
Right. That doesn't seem to be a saturation point. We've had 19 SPACs close de-SPACs this year. We've had 25 get announced. So we talk about this concept of a velvet rope in the industry, right?
Right.
Who's the arbiter of who gets to have a SPAC vehicle and who gets to take their company public through a SPAC? It's on all of us to really share our experiences from what we've learned in the last cycle and vet these companies and educate these management teams about what it really takes. Right? And not try and push anything into a SPAC vehicle.
Right.
That to me, I think, is a huge lesson that in this cycle, we're seeing better companies come to the SPAC market because we're seeing better sponsors come back to the SPAC market.
Right.
Yeah, I think the quality of the sponsors really is lending a lot more credibility to the SPAC vehicle and the industry itself, and people are starting to take notice that this is a good option again, whereas before it was, what I like to say, like everybody and their mother was doing a SPAC. Now it's a little bit more selective, I guess is really the word, right?
But it's a natural selection. I mean, the sponsors that we have
exactly.
conversations with that are considering going or launching a vehicle,
Yeah.
they're taking their time and they're evaluating their opportunity sets that are out there. Obviously not pre-identifying anything, but they have to have a sense of the probability of getting a good deal done. And so that takes experience, of having gone through it in the past before you go and ask all of your associates to put their money at risk with your money at risk.
Right.
It
You're
is a
more likely
lot of
to
work
do
that
it
goes into it.
if you've had success in the past or you have some type of experience. Right.
I think what's also important if you start talking about just pure number of SPACs is that during that time period, even though you probably wouldn't have had 500 strong deals, you had regulatory issues that kind of just where deals were abandoned and people were just cut out and said that's the end of it. So you had other issues at play there, but you are seeing sponsors that are coming back with more restraint, coming back a little smarter, they've learned some things, and they're not rushing through the whole process.
And do you think, go ahead, Josh.
And I think that sponsors are also acutely aware and focused on liquidity. I know the companies are. And so the ability to curate the investors in your SPAC so that you could try to mitigate redemptions. I mean, it's an issue that's prevalent now, and we don't have an immediate solution for the redemptions, and the redemptions are going to continue to remain high as long as we have investors in SPACs that are looking for a debt-like return and may not be an equity investor. And so as a SPAC sponsor, being thoughtful in terms of putting together the SPAC and having people that have had success with you before, respect your judgment in terms of the types of companies that you would look to combine with, and want to back you, and really want to get back to the theory that these were, the SPAC vehicle enabled, grandmas and grandpas and aunts and uncles to get into an IPO earlier, in the process. And so if we can start to, as we bring back more quality companies and more quality companies de-SPAC, and people understand from a long-term investment perspective that they can get back into this market or are able to get into the market, I do think that there's some real advantages there, but we've got to get back to those fundamentals and try to solve some of the problems
Right.
that folks have seen as an advantage.
Right. Yeah, I mean, I think that's important, right, is having the investor in there who wants to be for the long term, and that way, that whole issue with the redemptions really starts to resolve itself. And the quality of the sponsors is very key, the quality of the targets as well, being able to sell that story as well. And I think that's something that's important too, to get that the quality deal is to really prep the companies to be able to sell their deal. This is why you should do this. This is why you should stay, not only through the business combination, but long term as well.
Yeah, and companies are diligencing this. When they're thinking about which SPACs to combine with, they're asking those hard questions. Back in the day, they would, most people would be like, there isn't a whole lot to diligence on a SPAC, right? How much is in trust, some basic things that you tick through. But now it's really, are these investors going to be sticky? Are they going to be willing to sign non-redemption agreements? Are they going to be supporting me? Who can you bring to the table in a pipe? Institutional investors, how big a pipe can we raise so that we can get to that next value inflection point and have a little bit of cushion to really get there? So the companies are more educated today too, and asking the hard questions of the sponsors.
Right.
Well, Jocelyn, don't you think too there's a need for a change in the narrative around what the de-SPAC is, right? So typically in a traditional IPO, you have stickier investors. But in the SPACs, we haven't seen that, which is why the redemptions are high. But if we change the narrative, instead of them thinking of it as like a sell-side M&A event, and instead like an alternative IPO, they might be able to attract more of those sticky investors to stay long-term.
And and as people have said, to be rational with valuation.
Yes.
Right.
Okay,
I just think when you think about it, to your point, Caitlin, that it is an IPO alternative. It's not a sell-side M&A. You're not looking to take off every dollar of value.
Right.
As part of, hopefully this is the deal is well received. We don't necessarily want those big jumps like what we see in the traditional market. In fact, we use that as a sales pitch as to why you may want to de-SPAC, but you've got to get that valuation right? Like this should be a point where you as the entrepreneurs are not willing to sell at this point. You're going to be building your company. You want your stock price to increase. You want to be in a position where it's trading at a level that you can bring in institutions. You can do follow-on offerings. Convert your warrants if you have warrants in your cap structure, right? Because your stock price has performed, and then you can do, additional capital raises to broaden your investor base. So that really needs to be a work stream as part of this process. I think it's been long neglected that we're so focused on deal execution and getting the deal done. It's the beginning.
Yeah.
This deal is an adventure in the beginning. And we owe it to all of our clients to really help set themselves up for success. And sometimes it's hard because sometimes these deals shouldn't happen, right?
Yeah.
Where you can't go out there and you can't raise the capital and you're going to squeak by and you're equitizing people because you can't pay expenses. I'm not always the most popular person in the room, but sometimes you have to rationally say to everybody, let's take a step back, and why are we doing this?
Yeah.
And hopefully
Some
we'll have
things just
more of
shouldn't
this
happen.
because people will be more educated going into it.
Yeah, exactly. Yeah.
It's the need for a good PR team.
Yeah. Exactly. Yeah.
Yeah. No, I think that's right. A lot of the work is front-end loaded, before the announcement. When you think about how long it took historically to get a de-SPAC closed from announcement, it's been over a year, right? In 2024, it was 15 months.
Yeah.
And so far in 2025, it's a little less than that, but there's only been a few that have closed. I think this wave now with the SEC being a lot more constructive. Now, if everybody took the retirement package, there are not enough people there to actually work on helping these get closed. But this is moving faster. We're working on transactions where they're getting through the SEC quickly,
Yeah.
and they're able to close within 6 months of announcing the deal.
Right.
But it all comes down really to preparedness.
Right.
And once you make that first filing, you can get through those comments very quickly. You can get back on file quickly.
Right.
And then it's a question of just getting through that SEC process and not slowing it down and delaying your filing because you haven't solved
Right.
a problem you haven't thought of at the beginning.
Right.
Yeah, that's a great point, because you're coming to the S4 filing or F4 filing in a much stronger position, and now you're seeing it where the SEC comments are limited to maybe 2 rounds of comments, where in the past, it was a rush to get the S4 on file, and then you're on comment letter number 4,
Yeah,
and months
or
are
more.
going by. Yeah, right, or more.
Or more. And comment letter 1 had like
Yeah.
70 comments.
Right. Regulatory issues aside, it
Yeah.
would take up a big chunk of time.
Right.
It's a good reminder to ask for checklists. I mean that seriously. From all of your providers, whether it's your auditor, your advisor, your transfer agent, and your trust, to say, I don't know what I don't know. I want a checklist up front, so that you can go through those, and then it allows everyone to be on the same page, and then things don't get missed too. It's organization, from the get-go. I think is always paramount to the success of this.
It's the organization and the communication, making
Yeah.
sure everybody's talking to each other, making sure everybody's on the same page, and setting realistic goals.
Yes.
Right? You don't want to sit there and tell them, oh, you're going to be able to close in 3 months, and everybody else on the phone, the other advisors are like, yeah, that's not going to happen. But nobody wants to raise their hand and say that's not going to happen. And you really need to be open and honest on both sides.
Yeah, right.
You can't get an audit done in 3 days.
All right, thank you, Jen.
4. I give you 4.
And you don't want to be at the end of the process, the SEC process, and have had the vote, and still be working on stuff, right?
Yeah.
Whether it's the financing or, sort of the bane of my existence these days, the listing process.
Yeah.
Again, it goes back to liquidity. If you don't have round lots, or you don't have capital to support the company's growth and business plan for the next 12 months, you're going to go cycles with the exchanges. And the exchanges have gotten to the point where they really don't engage. They send out, the standard comments, but until they really see that the deal is going to close, because so many of them haven't, it becomes, a crunch at the end. And I think staying in touch, explaining why this deal is different. We all know what kinds of comments we're going to receive. Being proactive, pushing it through. And again, from my perspective, it really goes down to deal fundamentals. If the deal fundamentals are there, then the listing piece, should not become a gating item in an issue. But you're seeing deals, like there's a recent deal that went effective, and the shareholder meeting was in March. It closed last week. And that's a challenge for everybody involved in the transaction.
Yeah, you need to be ahead of the game, and you really, like I said, the communication is key, and setting the realistic goals, right, and letting them know, right, the listing process is going to be a gating item. Get ahead of it. Start working towards that. As soon as you have that, making sure you have your round lot holders. If you don't, engaging somebody who can help you get those round lots, and really working towards that end goal.
All right. Last thing you want to do is de-spec and end up on the pink sheets in a couple months.
Exactly.
Imagining that's not a
Yeah,
good
that's not a good thing. You don't want to do that. You definitely don't want to do that. So, and that, I don't know if anybody else has any closing remarks or anything. Give people back something.
No, maybe we could let everybody start having lunch a little early, right?
Yeah,
Questions?
no, there's another
No, there's
panel
no-
right
There's another
after
panel?
us.
Sorry.
Oh,
Yeah.
no lunch for
Sorry,
you.
People are starving.
Sorry, I'd let you go to lunch, but there's another panel, which is going to be a really good one too. So.
No, I think the big takeaway here is, the importance of staying on top of things, because there's so many moving parts of a SPAC and the life cycle of a SPAC. And so it's very easy for the ball to get dropped when there's a hyper focus on one silo and the other's getting ignored. So I think from any of this, if we can
Bless you.
teach, bestow any advice, it's like due diligence with all of your teams and putting them all together, so that we can all make sure that from the background perspective, we are also checklist and ready to go
Yep.
for you too.
That due diligence is key,
Yeah.
making sure that everybody really is on board and having the same message.
Get cell phone numbers.
Yeah, I guess for my parting, thoughts here would be, you mentioned a checklist, but of the criteria of what the company that you're trying to take public needs to have. And it doesn't have to check all of those boxes, but you should have a threshold of features that it should tick.
Yeah.
And if it doesn't, then you're probably forcing it.
Yeah.
And if it does, then validate it and go walk across investors, because those are ultimately the part of this ecosystem that you need for these deals to trade well and succeed. So, we don't talk about the investors enough, and that they have valuable input, because they're the ones that are putting capital into play. They have a lot of capital, and they're short of ideas. That's why sponsors, that's why they want to put their money with sponsors, both at the IPO and in the risk capital.
Right.
Because they want those great companies. They want to get wall-crossed.
Yep.
So really, find relationships with investors that you value, and bring them into the process and get their thoughts, because they will be speaking for the market.
Yeah.
And I would leave you with the work on the front end that may be viewed as prolonging the process or delaying, that initial announcement of the VCA or the filing of the SRF4. Making that investment up front typically leads to a much smoother process, and what you lose on the front end, you gain on the back end, and results in a much more efficient, less costly process, because any of these that get dragged out, I'm sure you all have seen, what the costs end up being, across the board, and some proper management and making some hard decisions up front can really save that on the back end and have a much smoother deal process.
Yeah, you definitely don't want to cut your nose to spite your face, right? You want to go with the advisors and the team that's really going to help you be successful, and making sure that you have that right team in place, the ones that have the experience, the know-how, and have been through it and can really guide you through that process. So you definitely want to do that. Like Jocelyn, you said, you don't want to, really try to save on the front end when, it's going to come back to bite you at the end. So.
Yeah. And what I think I would add is, although we are seeing some more sophistication, in a lot of these situations, audit is going to be needed. Have myself, Jen, get us involved as early as possible.
Yeah.
The last thing you want to do is sign something, and then you have 7 months to close a deal, and we need to start the audit, and we can't for a month, and it takes longer than we're walking into something that's going to take us 4 or 5 months to finish.
Yeah,
So
you definitely want to be prepared.
get us in as early as possible.
Yep. All right.
All right.
Well, thank you, everyone.
Thank you.
Thank you.
Appreciate your time. Thank you.
You want to go first?